and Laurie Baker, Senior Vice President of Funds and Asset Management, Camden Property Trust. So can you give us some insight into the benefits of operating a geographically diverse portfolio?
All right. Well, I'm going to assume that not everybody knows what, where we come from and what we do. Mm-hmm. So I work for Camden Property Trust. We are a multifamily company that I always say kind of is located in the smile of the U.S. We're not in the Bay Area here in California, but we are in Orange County, San Diego, and then go across the U.S. as far north as Washington, D.C. So we're definitely diversified in a number of markets, 14 markets across the U.S. We have about 55,000 units, and it allows for us to kind of weather the storm in different market conditions. Our strategy is to be focused where there's high employment growth, high population growth, and migration. Immigration is something that definitely benefits many of our markets, especially the Texas markets, and so the fundamentals are really strong right now in the multifamily business, and that diversity has bode well for us throughout our 25 years as a public company.
So where are you seeing the most demand in terms of the markets you're in?
So, if you want to measure the demand based on kind of revenue growth, just coming off our third quarter, we had our earnings call last Friday. Our strongest markets have been Denver. Orlando's been very strong. Houston has rebounded very nicely. That had a little bit of a kickstart with the tragic storm of Harvey, but for the apartment industry, that was a good thing for us. We had kind of weathered the storm in another aspect with the oil kind of crisis going on, and that kind of helped us move a little quicker with rebounding, and then oil was back up to over $70 a barrel, and that's good for the Texas market. Maybe not good always for consumers who have to buy gas at the pumps, but that does create a lot of jobs, and so we've seen that in the Houston market. And then Phoenix has been really strong as well.
Sure. Do you feel as though there is, I'm going to say, a systemic shift from markets that were traditionally Class A, like New York and San Francisco? Do you feel like people and their employers have been priced out of these markets?
So it's a little difficult for me to specifically comment on New York and San Francisco since we're not in those markets. But we choose strategically to be in markets where, again, as I kind of mentioned earlier, where there's strong population growth, you have a lot of employment growth. The markets we're in, the Sun Belt markets you may call it, are just areas where there's a lot of internal migration happening throughout the U.S., and some of those cities are typically not where you've always kind of had everybody was going to New York, everybody was going to Northern California, now they're going to Phoenix, they're going to Las Vegas, they're going to Austin, they're going to Dallas and Houston, Orlando, and those are because you've got just really pro-business environments there, not as much regulatory concerns, great climates, and that attracts people. There's jobs there, and they're going to go to those locations where there's jobs. And for us, the story is a good one in the multifamily business.
So I'm interested to hear about the trends of millennial renters. What are you seeing in terms of millennial renters? Are they averse to home ownership, or what's the trend here?
So, and Jennifer will probably talk a little bit about this, but being in the student housing, many of her residents then move into our properties. But I can share with you that the millennials have a strong propensity to rent. If you look across our portfolio, our average age is about 30 years old, and that's kind of risen in the last couple of years. There's a lot of things driving that. People are waiting longer to get married. They're waiting longer to have children. And so home ownership is not something that's happening in the 20s like it used to. They're waiting longer. And so you've got people now that are also making decisions on where to live based on where they work. And a lot of the demand that we've seen over this last decade has been in some of the urban centers where they were priced out. You couldn't get a single-family home in those markets anyway. And so people are choosing to be renters. I can remember, and it didn't seem that long ago, but when I first got into the multifamily business, we were the redheaded stepchildren. There was nothing sexy about apartment industry. It was all office, retail. There was a lot of other areas of focus in commercial real estate, and sometimes people even considered us as residential. I mean, and that wasn't that long ago. And after the kind of the downturn and the recession, the apartment industry came back strong, and it has been that way since probably 2010, 2011. And anybody that's interested in real estate has branched off into multifamily. I mean, from home builders to office, developers like Hines. You have Lennar in the multifamily business. So you're just seeing a lot of development in multifamily, and that's because there's a lot of potential renters. And that's with a large millennial population and all those demographic changes and shifts that are occurring with people just living in apartments a heck of a lot longer than they used to.
I think millennials, though, they also want a sense of community, a sense of belonging, and they are going to receive that in an apartment community versus owning a home and living alone.
Right.
And
that's the thing. If you look at 75% of our residents are single. So they don't want to go get a home out in the suburbs, and they can't afford, and that's the other demographic shift. Home ownership had reached about 70% at the peak before kind of the whole meltdown of the housing industry. And now it's around 64%. And what that means is, you have a lot more individuals, and a lot of singles, I think, used to say, I want to invest in my home. I want to build equity. I don't want to just be paying a rent check and not seeing something for it. Well, a lot of people after the downturn got no appreciation in the value of their homes anyway. So as Jennifer said, they want to live in a location where they can meet people in their apartment communities. They can be close to retail and their work, and a lot of the amenities we provide today in our communities create that sense of community, and it's a building that's activated, and it allows people to really it's a lifestyle change. It's all about lifestyle.
Yep.
Laurie, you're going to be meeting with a lot of investors over the next couple of days at the REIT World Conference. So if you could have one message resonate with the investment community about CPT, what would it be?
I think that it would be that our business is really pretty simple. It's driven by house formation, and it's driven by the population growth and employment growth, and those things right now are pretty strong in our economy, and so the apartment fundamentals are really strong. So it's a good story right now.